Hello. I want to take this time to talk about the difference between a mortgage and a deed of trust. In some states, if a home goes into foreclosure, the bank has to file a lawsuit to get the house back. In a lot of states, especially those that have deeds of trust and not mortgages, then the bank doesn't have to file a lawsuit. It doesn't have to prove anything. It can just send you a notice of default, which that's typically what happens. And they give you up to 120 days security default. If you do not, then they'll sell the house on the courthouse steps. Now, that seems kind of drastic, but that's what's happening to a lot of folks. Some people, to avoid that, they'll do cash for keys, or they'll just simply move out of the house, losing the equity and everything else in it, and just go live with family or go live in a weekly at a hotel somewhere, which is absolutely crazy. But, people do what they have to do to survive. So I want to talk about some of the things to get the bank to do a loan modification. The Obama administration did the Making Home Affordable deal when he signed an executive order after 2008, 2009, when the banks did all the liar loans. They made the banks come to the table to modify loans rather than foreclose them, or at least they had to work out some type of mitigation strategy or show that they in good faith tried to do that. But after he left, and the next administration and the next one after that kind of repealed those things or just let them die because they never enacted them into actual law, then it became really optional for banks to do that. And of course, the Federal Reserve, which is neither federal nor reserve about anything, they're just rich one percenters that run the country, not Congress, not the president, but these rich one percenters that make all the rules and release things that are unmentionable on people. It's caused just a lot of economic distress. So as far as housing, people need to live somewhere. We're going to talk about that. So let's talk about the difference between what's negotiable and non-negotiable. Money is a negotiable instrument. You can trade it. It says right there on the money, this note is legal tender to pay all debts, public and private. A promissory note is a negotiable instrument. And when you buy a house, you sign a promissory note that you're going to repay the money. If you borrow money to buy a car, you sign a promissory note. If you sign for a student loan, you sign a promissory note. Those are negotiable. A negotiable instrument, even though you may buy it from me, for example, I can assign that note to my friend and tell you, hey, instead of paying me, pay my friend because my friend paid me off for that. So now you owe him the money instead of me. However, if a note is securitized and put into a pooling trust, it is no longer a negotiable instrument. It's a securitized instrument. And we're going to talk about what that is right now. So every 14 days, how these banks have been doing this for many, many years, every 14 days, all the banks that have mortgage loans out there or car loans or student loans, they batch these loans together and they bond them together like a bunch of carrots. So imagine your negotiable note being a carrot. And what they do, they take your carrot along with millions of other carrots around the country and they put them together in a bundle and they put them in a big giant blender and they grind all these carrots down and they blend them into carrot juice. Then the investors around the world, Deutsche Bank, guys in Germany, guys in Poland, guys in wherever, they could be in Japan, these investors, these one percenters, these guys who are members of the Federal Reserve, they get a little bit of that carrot juice, which is that represents their dividend. So they get a dividend for the investments that they made. Now, in order for that person to foreclose that house or to repossess that car or to default that student loan, that investor has to reach into that pitcher of carrot juice and pull out the original carrot, which is a legal and physical impossibility. So we're going to talk about how difficult it really is for your home to be foreclosed and why you can really ask the bank and push them to do a loan modification if you're working and if you have the income that you can afford to keep the home, but just not at the payment level because the interest rate adjusted such that it was just difficult for you to keep up with it, or the taxes adjusted, or the tax assessor came and without you doing anything, but so the county can get more money, they raise your taxes, even though you've done nothing to your house to raise the value. They just made up a value to increase your taxes. But when you got ready to sell the home, you found out that you weren't going to get that same amount of money that they claimed that it was worth. So let's talk about some of the challenges to securitization. One is the chain of title. Notice that when you signed your original loan documents, that the real estate agent, you signed them, but they gave you those documents in blank. No one else really signed them. It was you and the person who was in the room, your real estate agent, and the investor wasn't there. So when that loan, or rather when that note was securitized and put into a pooling trust, now it changed ownership, and the person who owns it is called an investor. So what happens once your loan has been securitized, sold on the secondary market or whatever, they hire a loan servicer to service your loan, like Citicorp. It can be a number of them out there. Wells Fargo. It can be some of these other name servicers out there that are handling your note. Now, that's not who owns your loan. That's who's collecting the mortgage payments. However, notice that if you miss payments or go into foreclosure, they're usually on the documents that's saying that you defaulted. But they have no legal standing to be there because they have no financial interest in it. They're just handling the financial transaction. They have no interest. They're just being paid to do what they're doing. So that's a problem, especially if you're in a jurisdiction where the bank actually has to file a lawsuit. You can challenge their standing and say, the one person who should be in this lawsuit is not named, and that is the actual investor. That is the holder of the note. Who owns this note? And you're not going to find that out because the investor usually signs an affidavit to never, ever disclose who the actual investor, the person who owns this note, who they are. But notice that when you go through the modification process, they say, oh, well, we got all your information, but we sent it to the investor for the investor to approve it to find out whether they're going to accept your offer. Then if that's the case and you sue the bank, then the investor needs to come to the table, right? I mean, that should happen because legally, only people who have standing can appear or testify or can fight in a lawsuit. And these secondary people out here or organizations that have absolutely no financial interest, no real financial interest in the outcome of your case at all, shouldn't be in it, including MERS, because the Supreme Court has already determined that MERS is not a bank. MERS is the Mortgage Electronic Registration System, and is often used to track ownership, but the courts have frequently ruled that MERS is a nominee and lacks the authority to transfer a note in a foreclosure. So if MERS is listed in a foreclosure document, that's a problem. So let's talk about how the banks push you into this foreclosure situation anyway. First of all, what they'll do and how it happens is that let's say that your mortgage hypothetically is $1,000 a month and you've been paying it $1,000 a month diligently. But then when you make your January payment, sometimes during that month or before, the tax assessor came out and reassessed your property and your property taxes went up, which means the value of your home went up, so your insurance went up too. So now instead of your payment being $1,000 a month, it's adjusted to $1,500. But because you have a servicer who's managing your loan, that information may not get to you for 60 to 90 days, that your mortgage payment has actually gone from $1,000 to $1,500. So in February, when you make that $1,000 payment, because it wasn't $1,500, the bank does not apply that $1,000 payment to your mortgage. They place that payment into what they call suspense. And then when you make your March payment, they'll take $500 from that $1,000 in March and apply it to February $1,000. So now that's $1,500 that you just paid in February, thinking that you paid March's a mortgage payment, but no. So now March is a $500 less. So your March payment, it only has $500 held in suspense for that. So when you make April's $1,000 payment, they're going to take that whole $1,000 and apply it to March because you needed $1,500, and none of those payments get counted until the entire balance is there. And so that's how you fall into default without you even realizing that that's happening. And the bank doesn't say anything about it until that deed is done. And then before you know it, you're wondering, how in the world did I get into this default situation? Well, that's how it happened. It is a very unfortunate but legal scheme that the banking industry performs on its people. And your tax assessor is a part of it, and your insurance company is a part of it. They all know what this is, but they all play into it because they all make money from it. So because these folks lack standing to foreclose your house, you can challenge that in a court. Now, courts are supposed to be places of equity. Now, we know that has changed over the years. But if you get a good attorney can argue these things. And if your attorney doesn't know, have them to contact me, because I'll teach them the principles of what they need to do to go and help you save your house. And listen to this. If your home has already been foreclosed, but it hasn't been bought, so a bona fide purchaser of value who didn't know about, anything legal happening, didn't buy it, but the bank didn't sell it off or didn't auction it off on the courthouse step, but the bank still has that in their portfolio, you can get back in that house in 72 hours after that loan has been modified. So even if the house has been foreclosed, since real estate is unique, there's no other piece of property in that place like yours. Is very unique. You can argue that you want to be back in your unique house. And as long as it hasn't been sold to a third party who was not, a part of anything that was going on and had no knowledge of it, you're good to go. And you can probably get your house back. And a good lawyer understands those things, and they can help you. And if they don't, they need to contact me. I'll show the lawyer how to do it, and your lawyer can help you. So what a pooling and servicing agreement is that once those notes are modified, or rather, once they're securitized and put into a pooling trust, those mortgages are governed by the pooling and servicing agreement of the banks and the investors and the financing agencies that agree to do that. And they have to be endorsed at least 5 times before they go into a securitized trust. And if that note hasn't been securitized, endorsed at least 5 times, it can't be put in that trust. So when you go to court, one of the things you challenge is the authenticity. You want to see the ink wet document of the endorsements that were signed along with your signature to say that this investor now owns your note. And I'm going to tell you, 9 times out of 10, they don't have that. And you know why? Because once that paper is registered with MERS, the Mortgage Electronic Registration System, they usually destroy or shred the original document. So if your argument to the court is, Your Honor, I want to see the ink wet paper that was signed with my signature and all those endorsements, including the investor who owns my note right now, or who owns or holds the title to my property right now, I want to see them. And I want them to be here in court. That's when it falls apart. And they rather modify your loan and help you to stay in your house rather than take it away and sell it again 2 or 3 times under the same scheme, just making money over and over again. So there's also missing and fraudulent documentation. When you sat at your mortgage closing, you probably sat there with a real estate agent and maybe some other person who was there. But was the lawyer there from the other side? Because, his name is on the HUD settlement statement. Look at your HUD 1 settlement statement and see how many of those people got paid, or how many people are being paid on that HUD 1 settlement statement. Because if those people were not at that closing, because that HUD 1 settlement statement is verifying that these people were at the closing, you'll see 8 or 9 different, or 5 or 6 different entities on there that were not there. So they falsified a document. And if those people were not physically there and you paid them, or there was money taken out that paid them, that's a problem. They falsified a government document. And in a court of law, a court of equity, that's a problem. Your lawyer needs to help you to take care of that. So here's some of the things you can argue. A broken chain of title, the lack of standing, the pooling and servicing agreement that was not properly endorsed until that servicing trust, missing and fraudulent documentation, and the use of MERS, right? And so these strategies are not guaranteed to work 100% every time. It just depends. But they usually work 90% of the time. And during the time when I was practicing law and doing this, I think we filed about 300 of these cases, and we never lost one. So, I mean, it didn't always go through court to a trial, but 90% of the time they would settle, and they would just go ahead and they would just take care of the issue, and they will modify the loan. But one of the things we would do is that we would say, hey, my client can't pay a $3,500 mortgage or a $2,800 mortgage. But if you would modify this loan to under $1,100 or at $1,100 for the next 15 and a half years instead of the next 25 or 26 years, and if they make 12 on-time payments over the next year without missing, without being late, then anything that was behind or defaulted or whatever will be considered discharged. And after they paid these payments, because of what happened, your mortgage will be considered paid. And we can show you the technique of how you can pay off a 30-year mortgage in 15 years or 12 and a half years without making double payments. And how do you do that? Well, you prepay the principal, because banks, the way that money works, banks and other financing companies cannot charge you interest on money that you have not used for 30 days. That's why when you buy a house or you buy a car, notice that your payments are set at least 30 to 45, sometimes 60 days out from when you made that purchase, because they have to give that interest time to cure. So if you, let's say, pay your mortgage payment on the 1st of the month, and then you go on the 10th or the 12th of the month, and you look at your amortization table and see how much of that principal is actually, how much of that payment is going to principal. Out of your $1,000 payment, probably $150 is going to principal, even if it's that much. And so if you prepay your principal for the next month, so if you make your January payment and then you prepay the principal, which may only be $150 in February, or rather in mid-January for February, the bank can't charge you that interest on that money because you prepaid it for the next month. And so that's how you'll end up paying off very quickly a 30-year mortgage or a 20-year mortgage or a 15-year mortgage, whatever you sign, in almost half the time, or a little over half the time, depending on how much you're paying and how you have it structured and set up, because you're saving all of that interest. These are things that you just need to, this is not rocket science. It's the way that people who deal with money do it all the time. They just don't want you to know it because they don't want you to own anything anymore, and they want you to like it. They want to take control of everything. Who are they? Well, they're the one percenters. They're the ones that are making you feel like that you're just struggling right now. We forgot that there's an old bartering system that we used to do in this country many years ago. And if you need to even claim other income or more income so you can qualify for things that you can buy, you can barter with folks as far as, especially for like-kind exchanges for vehicles or food or whatever it is that you want to barter for. And then if it's a service, you can barter for services and then claim the value of those services on your taxes. And that's perfectly legal. You can do that. And the IRS will prefer you do it anyway, because any money that you make, they want to get their claws in it. So if that's what you want to do, you can do that. And so you don't have to say, well, I don't have a job, I'm not broke, I don't have any income. Yes, you can have income if you barter your services with other people. Like-kind exchanges work all the time, man. If you have a camper and somebody, has something that you want, was a vehicle, a boat, or a mobile home, or whatever, and you want to trade that camper for a mobile home, then do that. Or you want to trade your fifth wheel for something that's on wheels that you can live in, then do that. And you don't have to, and it could be a straight across exchange, and you can report that as however you want to on your income, but it's doable. It's especially better for services rather than like-kind exchanges, because you don't necessarily have to report those as far as their income. But if you barter services, if somebody, let's say, wanted to give you credit services in exchange for some type of consulting that they're doing for you, then they can help you repair your credit and get that straight, and you can consult with them on how to make their business structure better. And if the value of your service is $8,000 and they value their service at $8,000, there you go. And none of you had to actually pay that dollar amount out, but you can claim that as value that you got in exchange for the services that you received. And you can do that. They used to do that in this country, but we've forgotten about it now because they got you too distracted and looking at and worried about other things. So until next time, we'll talk about something else. Eventually, I'm going to start a weekly forum like this where I'll be even taking questions. We can do it on a Zoom type of platform where you can ask questions and we can have a real discussion about things that are happening in the world right now. So until next time, be good out there.